Harsha Upadhyay, CIO for Equity at Kotak Mahindra AMC, is joining us right now on the show. Harsha, good morning to you. Devina here. Let's start off with your view as we step into 2019.
Good morning.
And keeping in mind the various risks that we are facing right now in terms of global volatility, overall India elections and the volatility thereof, earnings that will play out, the interest rate regime that we are in. So there are multiple factors, and how would you approach it?
We look at 2019 as a better year compared to 2018. We believe the first half could be as volatile as the previous year. But I think once we have elections out of the way, I think markets would start showing a lot of strength, in our opinion. We are expecting earnings growth to come back to about 18 to 20% levels in financial year 2020. This is on the back of the fact that the corporate-facing banks will saw lesser provisioning and hence better profitability in the year 2020, and that should take the overall numbers towards high teens at least. We also expect some of the macro tailwind to really gather strength further. There was an adverse movement in crude currency interest rates during 2018, and that has got sorted itself out. And we expect the benefits of that to start coming in from this calendar year. And that should also play a positive role in terms of stabilizing the markets. All in all, we are more optimistic on 2019 as compared to 2018. However, the volatility in the first half could be similar to that in 2018.
From a market standpoint, I mean, we've got a few other brokerage reports suggesting that you should not expect anything big or grand in terms of the returns from the equity markets in light of the already high valuations. At 17 times, you're still above the 10-year average in terms of the index PE.
We are slightly above the long-term average in terms of valuations, but what we need to keep in mind is if the earnings trajectory is going to be much higher than what we have witnessed in the last 3-4 years, then definitely there is a case for re-rating in the markets. And also that would depend a lot in terms of what comes out of elections. But if you have a stable government and if there is policy momentum continuing, and assuming that the global macro continues to be benign and helpful for Indian economy, then I think there is every reason to believe that the markets can trade at higher valuations, and that's what we believe will happen.
Let's talk about the here and the now in terms of the Q3 numbers which have started trickling in. The big IT names are going to be reporting numbers. You already had one come out with its numbers. What is the anticipation, and how do you think this earnings season is going to be? Because Q2 was more disappointments than upbeat numbers.
Q3 is definitely going to be disappointing if you are looking for any uptick in terms of earnings growth for the year. I think because of the high input costs that were there in the middle of 2018, and that will flow through the numbers during the third quarter of this financial year, and hence numbers would be weak wherever you have those issues. And also NBFC liquidity crunch happened during the quarter, which means some amount of demand disruption has also taken place. Given all this, the Q3 numbers are unlikely to give any confidence for anybody to really extrapolate and believe that the numbers would be higher going forward. But what we need to keep in mind is some of the issues which affected Q3 earnings, or which are likely to affect Q3 earnings, have all turned very, very favorable in a very short span of time. And with a lag there, they will positively impact earnings growth trajectory, and that's what we are betting on.
Interesting. Harsha, good morning, Neeraj here. Would you largely believe that
good morning,
domestic investors and AMCs in particular would have a slightly difficult hand for 2019 being dealt to them as opposed to what happened in the better part of 2017 and maybe the early half of 2018? Because it's difficult to envisage flows being in the same vein as they have been in the recent past. And maybe December, the month of December and the flows thereof stand testimony to that.
I agree. The flows have reduced a bit compared to where we were earlier. And most likely, given the volatility and the big event that is coming up in 2019, we could see similarly subdued numbers for next couple of months. But what is hurting is clearly the strength in SIP numbers. In all this, SIP numbers have continued to move up. They are in excess of 8,000 crores a month. And once we see some stability in terms of overall market dynamics, I think even the lump sum investments should come back, because the structural change that is happening, which is moving away from physical investments into financial investments, is definitely there. I don't think there is any reversal in that trend. So once either the valuation is correct or some of the big events are out of the way, we can expect money to come back to equity markets once again. And hopefully until then the SIPs would give a lot of stability to the overall flows.
Okay. Harsha, you know, we were just scanning through what most of the sell side believes would happen in quarter 3, arguably quarter 4. And again, the earnings growth may not quite live up. While that is a known fact, where do you believe the next couple of quarters, which is the quarter gone by and the delivery which is to happen now, and the current quarter, which is Jan, Feb, March quarter, will see the best earnings delivery? What pockets would do that? And would those pockets present an opportunity in the current market scenario to make fresh bets on?
We believe private sector financials will continue to deliver a strong growth, and that should continue into Q4 as well, and as well as in financial year 2020. We also expect sectors like IT, capital goods, etc. to really show decent numbers. We don't see much of volatility there as well. What could be disappointing in terms of earnings expectations would be sectors such as auto, telecom, etc., where you would see further pain during the quarter, and that could continue into next few quarters as well. So overall, I think it will still be driven by private sector financials, capital goods, maybe a little bit of ITs, and those sort of sectors for Q3 and Q4. And as we get into financial year 2020, I think the real benefit would come from some of the corporate-facing lenders, where the provisioning numbers would be a lot lesser, and the credit costs will also start getting gradually moderated, and that should really lift up the overall earnings. Because if you look at September 2018 quarter, if you leave out 3 corporate-facing banks from the Nifty basket, the rest of 47 companies have actually grown at about 16% year on year. What we're essentially looking at next year would be similar trend rate for 47 companies, give or take 1 or 2 percentage points here or there. But essentially the 3 corporate-facing banks should deliver more than that, and that should lift up the overall earnings towards that 18 to 20% range. That is what we are hoping at this point of time.
Harsha, 2017 was a year of the mid caps and small caps. 2018 was a year of the large caps. Do you see a reversal come 2019, or it's still going to be being a little bit more safe, putting money in your well-known large caps where you know there could be more equity protection, rather as compared to some of the high beta mid cap and small cap names?
If you look at relative returns from mid and small cap basket as compared to large cap basket for the last 12 months, it's at an historically extreme level. And usually in the past, whenever such divergence has occurred, it moves back to normal zone, which means this year we should see a relatively better performance from mid and small cap basket as compared to large cap. Having said that, I would also point out that first half could be more volatile for mid and small caps. I don't think across the board the valuations have become so compelling yet. Yes, there are pockets of opportunity, and you have to be careful in selecting the stocks that you would bet on in the mid and small cap segment. If you do that, there is enough money to be made on a relative basis as compared to large cap basket, even from these levels. But if valuations were to correct further for any reason in the mid and small cap category, then it would present even greater opportunity, I would say.
Okay. Well, it's an interesting note, I think, by Edelweiss, which spoke about how after every large year of underperformance by small caps, the next year they tend to outperform. Let's wait and watch if it happens this time around or no. Harsha, just one question, one final question from my end, and that's on, I'm not asking you to comment on a stock, but a lot of branded names across businesses have seen valuation deratings coming in. Maybe the earnings slow down or maybe specific events. I mean, Eicher Motors, Page Industries, a couple of names and there are a bunch of others out there. You think, I mean, I know they are all different businesses, but okay, let's start off with, or maybe let's talk about those ones which are consumer oriented or consumer facing. Do you think there are temporary bouts of weakness in an otherwise structural growth story, or at some point of time valuations have to come off and people should adjust with the new norm of the valuations?
See, I think in the consumption-oriented segments, one has to be careful about valuations. We all know that this segment has delivered a great business performance in the last 5-6 years when the markets were not delivering that kind of steady returns, which means a lot of money has gone into these stocks. The ownership is quite high. And at the same time, we have seen some tapering in terms of demand momentum, and that's not across the board, but there have been few stocks where we have seen a slight slowdown in terms of growth numbers. And also we have seen in some cases the input costs going up because of what happened in global commodities market a few months back. Given all this, there is margin pressure, there is moderating growth environment, and if the valuations are high and if the ownership is large in these segments, then one has to be really careful. Other than that, I don't think you can take a complete negative call on the entire consumption-oriented segment. There will still be companies and businesses which will still grow at reasonable rates, and those will sustain those valuations. But other than that, I think there is risk of valuations getting derated.
Harsha, any theme that you feel is going to take prominence in 2019, be it on the backdrop of global commodity prices, be it on the backdrop of the capex cycle picking up, be it on the backdrop of the peaking out of NPLs?
We are positive on corporate-facing private sector banks. We believe that those segments will see revival in terms of stock market performance. Clearly, the retail segment has continued to do well, and added to that, if NPA cycle starts to improve a bit, there would be a large valuation gap that some of these stocks would bridge compared to their peers in the category. We are also positive on engineering and capital goods and some of the other economically active and linked sectors, wherein we believe the current momentum would continue until elections, and if we can expect a stable government post that, and that momentum should continue, and the valuations are very reasonable. For example, engineering and capital goods sector on a relative basis is similar to where it was in 2002. In 2002, as a relative of the overall market cap, as a proportion of the overall market capitalization, it was about 6%. And in the peak of 2008, it went to all the way to 15%. And now again, it's back to 7%. So in a way, the valuations have corrected to the early 2000 levels in engineering and capital goods sector. And the operating leverage there also is quite high. And as we see some green shoots in terms of demand, you should see exponential improvement in profitability. And that's what we are betting on. We are betting on engineering and capital goods, which are short cycle oriented. We still do not see any large ticket investments happening in the economy. I think that is still some time away. But wherever the capacity is already in place, and if we see some order momentum building up, those are the pockets to really bet on.